Hi, this is Qiao presenting my fundamental analysis on Singapore Technologies Engineering Limited. First up, I'll start off with the background information of ST Engineering. It is established in 1997 in Singapore, who specializes in providing innovative solutions and services in aerospace, electronics, land systems, and marine sectors. Here's a pie chart showing the contribution by business segment in 2013. As can be seen from the chart above, aerospace takes up 32%, whereas marine takes up only 19%. This might be due to the higher demand in aircraft than shipping services. ST Engineering is one of Asia's largest defense and engineering group. They are also the largest companies listed on the SGX. With a component stock of the FTSE Straits Times Index, FTSE ASEAN 40 Index, and MSCI Singapore. With over 100 subsidiaries, joint ventures, and associated companies, they have a global-wide network of customers from over 24 countries, and with an employee size of 23,000 people. From the pie chart below, you can see that Asia takes up 62% of the earnings, which might be due to the emerging markets of China and India. They seek opportunities in the US markets as well, by setting up the Vision Technology System Incorporation, known as the VT system, in 2001 to deliver excellent ST engineering services to America. This can be seen from the progressive results shown in their financial statements. They have also representative office in markets such as London, UAE, as well as growing markets such as Brazil and India. Now, what is fundamental analysis? Fundamental analysis is analyzing of companies' financial ratio and understand the rationale and reasons behind all this ratio. This allows investors to know how well the company has performed, whether they are outperformed the benchmark or whether they underperform their targets. That is very beneficial for investors to decide whether or not they should invest in the company's stocks. I'll be sharing 3 types of ratio: the valuation ratio, profitability ratio, as well as the financial stability ratio. Firstly, I'll touch on with the valuation ratio. What is the valuation ratio? It is the attractiveness to invest in a company. I'll focus on the price-earning ratio. It compares the company's current share price against its earnings per share, which can be seen from the formula given: the market value per share divided by the earnings per share. For the result from the past 4 years, you can see that there is a drop in the PE ratio from 2010 to 2011 by 5.5. However, there is a rise in PE ratio since 2011 to 2013 to about 21.1. With higher PE ratio, investors are more willing to purchase STE shares. Moving on to the profitability ratio. What is profitability ratio? It refers to the business ability to generate future profits. Earnings per share is one of an important indicator to determine the share prices. It is calculated by deducting dividend on preferred stock from net income divided by the average outstanding shares. As for the gross margin, it is calculated by revenue minus COGS which means cost of goods sold divided by the revenue. The higher the percentage, the more the company retains on each dollar of sales to service its other costs and obligations. As seen from the table above, the gross margin increases from 21.1 in 2010 to 22.8 in 2012. However, a slight drop of gross margin in 2013. For the profit margin, the formula is the net profit divided by sales. You can see that the higher profit margin indicates more profitable the company is in controlling their costs. In 2013, it shows an 8.8% profit margin, which means STE has a net income of 8.8 cents for each dollar of sales. Next, for the return on assets. It is the net income divided by the total assets. To give an idea of how efficient the management is at using its assets to generate more earnings for the company. SCE shows an increase in the return of assets from 2010 of 6.9% to 2012 of 7.5%. However, a slight drop of 0.6% occurs in 2013. Last but not least, for the return on equities, it is the net income after tax divided by the shareholder equity. It measures the company's profitability with the money that the shareholders have invested. Same things happen. There is an increase from 2010 of 30.8% to 2012 of 31.5%, and a drop in 2013 again. Return on equities is also one of Warren Buffett's favorite parameters. So now, let's take a look at the peers' performance. I've compared STE with SI Engineering, Cable Corp Limited, as well as Sabcorp Marine Limited, which is one of the strongest competitors against STE. You can see that STE overall outperformed its peers in 2011 to 2013, and by comparison with its share price against peers and benchmark for the past 1 year, it shows that STE still outperformed the expected growth. For conclusion of the profitability ratio, we can see that for every ratio that we have compared, from earning per shares, gross margin, profit margin, return on asset and equity, you can see a similarity, which is a decline in the ratio from 2012 to 2013. And I have researched and found an article which can sum up the conclusion why there is a small decline in its profitability ratio. This might be due to the global market remaining weaker and uncertain. Even though STE cash and cash equivalents remain high at 1.8 billion. After the payment of the final dividends for the financial year of 2013 of 37.4 million. And as can see by comparing with its peers, it also shows that there is a slight drop from 2012 to 2013. Thus, I concluded that the global market and uncertainty, the weak global market and uncertainty affects the whole economy as a whole and not just STE itself. As for the financial stability ratio, the last ratio that I'm sharing, the debt equity ratio, it refers to the measurement of the company's financial leverage by dividing total liabilities by stockholders' equity. From the ratio above, STE have a low debt to equity ratio. There's a decrease in the figures from 2010 of 0.8 to 2013 of 0.6. This shows that they uses less leverage, hence they have a stronger equity position. Next, for the current ratio, it is an important indicator to indicate the company's liquidity condition in terms of paying off the current liabilities from its current assets, such as the account payable and interest payable. STE have a consistent ratio of 1.4 for the past 4 years, as seen from the table above. It shows that the company is relatively healthy in its business, and they are able to pay off its current liabilities using its current assets. Last but not least, for the interest coverage ratio, it is a dividing of earnings before interest and taxes by interest expense. From the table above, you can see that there is an increase of ratio from 10.7 in 2010 to 14.3 in 2013. This ratio determines the company's capability to pay interest on an outstanding debt. By having these figures, you show that there is a steady growth of ability to return their debts. This further proves that STE is financially stabilized company that investor will be safe in placing the investment with. All in all, I concluded that I believe that Singapore Technologies Engineering Limited can perform well since it is a huge company operating in different business sectors, the aerospace, marine, and many more. And by comparison with the valuation profits and financial stability ratio, there is an increasing trend overall, even though there is a slight drop in the percentage due to the economic factor. But this affects the whole economy, so it wasn't a big problem for ST Engineering. They outperformed its benchmark as well as its strong competitors like Sembcorp Marine Limited, Keppel Corp, and SIA Engineering. This proves that STE have the potential to continue to develop and they also continue to seek opportunities to expand its business overseas through partnership and also acquire huge contracts over the past few years. And recently, they managed to secure new contract worth $520 million with a regional US airline. Thus, with all this news and fundamental analysis, I wish to invest in STE as this would provide me with good returns. And I'll end off with my presentation here. Thank you.